everyone, I'm back again with another video. If you saw my previous video, then you probably know that this video is going to be a continuation from what I covered last time. Before I talk about today's topic, which is fundamental analysis, a continuation of fundamental analysis, I'd like to introduce a quote from a book author, Nick Murray. Nick Murray wrote, "Simple wealth, inevitable wealth," and in his book he states that wealth isn't primarily determined by investor performance as it is determined by investor behavior. This proves to show that the stock market is a game of emotions. The more control you have over your emotions and use them when necessary, the higher advantage you have over others who enter the stock markets. Even though strategies constitute decision-making, it's ultimately your behavior that's going to make the final call, so it's important to have a balance between the two. With that note, let's get started with today's video. Now, in today's video, we're mainly going to be taking a look at the different ratios investors can use as a part of fundamental analysis. But before that, let's have a mini review of what I covered in part 1. Fundamental analysis basically sums up the entire research process an investor takes in order to analyze a company's stock before investing in it. In this research process, we are determining a company's real or fair market value, and we do this by looking at the company's financial statements. There are also external factors to look at, such as micro and macroeconomic factors, but the main way people analyze stocks is through looking at a company's financial statements. There are 3 financial statements to look at, and that's the balance sheet, the income statement, and the statement of cash flows, which I've covered deeply in my last video. Since looking at financial statements might be long and tedious for some investors, these investors might take a shortcut and use specific ratios in order to analyze stocks. There are important ratios investors look at while they trade. I've listed all of them right here on this slide that we're going to cover in today's video. These ratios help simplify the process as investors don't need to spend too much time analyzing the financial statements of a company. The first ratio to look at is the working capital ratio, which is commonly used to assess a company's financial performance. It measures a company's efficiency and the health of its finances by looking at short-term assets and short-term debts. The working capital ratio reveals whether the company has enough short-term assets to pay off its short-term debt and is represented by the equation current assets minus liabilities over total assets. There are indicators you can look for while using this ratio, and that's through looking at whether the working capital ratio is negative or positive. A negative working capital ratio shows that the current assets of that company are less than its liabilities, which shows that the company is at higher risk of bankruptcy, and that isn't a company that you want to be investing your money in. This is an indicator that investors shouldn't invest in a company because of its risk of bankruptcy. A high working capital ratio isn't great either because it shows that a company is letting their cash reserves sit idly instead of distributing them as dividends to their stockholders, so that's another sign to look for. I've listed the price ratios right here to look at to see whether or not you should invest in a company. If the working capital is less than 1, that means liabilities are more than assets, which means that a company is at a higher risk of bankruptcy. If a working capital ratio is between 1 and 2, that's the perfect working capital ratio to look at because there's enough assets to cover a company's liabilities while also distributing profits as dividends. If a working capital ratio is higher than 2, that means a company is letting their cash reserves sit idly instead of reinvesting them as profits and as dividends to their stockholders, which isn't a good sign. The second ratio we're going to be covering today is the quick ratio, which is also known as the acid test ratio. If you're wondering why they call it the acid test ratio, I have no idea either, so don't ask me. This ratio indicates how current liabilities are covered by cash in the company. The quick ratio is represented by the equation quick assets over current liabilities. If you don't know what quick assets are, it basically includes anything that can be converted into cash quickly, such as cash and market securities. In the working capital ratio, I mentioned current assets, but even though quick assets and current assets might sound the same, they're actually not, and here's the difference. Current assets include assets such as equipment, property, and inventory, but since those assets can't be converted into cash quickly, they're not considered as quick assets. Therefore, quick assets are more conservative than current assets. As I've mentioned before, the quick ratio indicates a company's capacity to pay its current liabilities without needing to sell any of its inventory or get additional financing, which is why quick assets are used. The quick ratio is important for stockholders to look at because you can use it to compare companies that operate in the same industry or sector and determine their financial health. It also shows how fast a company can cover its current liabilities. The higher the ratio, the better a company's liquidity and financial health, and the lower the ratio, the more likely the company is going to struggle with paying debts. Here's an example. Let's just say that company A has a quick ratio of 1.1, while company B has a quick ratio of 2.5. Since both of the quick ratios are greater than 1, that means the company has enough quick assets to cover their current liabilities. But even though they're both greater than 1, stockholders would pick company B to invest in because of its higher ratio, because it shows that company B has more quick assets in hand than company A. The third ratio we're going to be looking at is EPS, or also known as earnings per share. This is pretty self-explanatory in that it measures net income earned on each share of a company's common stock. The equation total earnings over outstanding shares represents this ratio, and a higher ratio shows more profitability because you're gaining more money per share. Earnings per share is important because growth in EPS is an important measure of management performance. It shows how much money the company is making for its shareholders, not only due to changes in profit, but also after all the effects of issuance of new shares have taken place. For example, take two companies, Company A and Company B. They both have earnings of $2 million, but Company A has 1 million shares outstanding, while Company B has only 100,000 shares outstanding. Company A has an earnings per share value of $2 per share, while Company B has an earnings per share value of $20 per share. You would want to invest in Company B because it has a higher earnings per share value with an $18 per share difference. So that's just saying that each share you purchase from Company B would be $18 more than Company A, which is a pretty good profit if you ask me. The previous example we looked at for earnings per share was pretty easy to understand, but it doesn't cover all of the possible situations you might be presented with in the stock market. So here I created another example. Let's just say that you have to pay $200 to purchase one share of Company A, and the earnings per share value is $20. That means you can expect a $20 profit by paying $200 for one share of Company A. On the other hand, you have to pay $15 for one share of Company B, and the expected profit would be $2 per share. In this instance, neither the price of the stock nor the earnings per share value is the same for both companies, but a way you could evaluate both of these stocks and compare these two stocks together is by converting the earnings to share price of Company B so that it's similar to Company A. You would do this by multiplying both the stock price, the amount of stocks you have, and the earnings per share price by 10 in this particular example. By doing this, you can see that Company B would require $150 for a $20 profit, whereas company A requires you to pay $50 extra to expect the same amount of profit. Therefore, a smart investor would invest in 10 shares of company B instead of paying $200 for a share of company A because they're paying less for the same earnings per share profit. Now we're going to be looking at the price to earnings ratio. The price to earnings ratio is the most commonly used by investors during fundamental analysis as it relates a company's share price to its earnings per share. The PE ratio is important because it tells you how much you're paying for each dollar of earnings made by the company, so it serves as a type of measuring stick. Evaluating a PE ratio might be difficult to do because low and high PE ratios aren't inherently good or bad. A high PE ratio could mean that a stock's price is expensive relative to earnings and possibly overvalued, but there also might be other factors that contribute to a high PE. For example, if investor confidence goes up in a particular stock, that contributes to a higher PE ratio because more people are buying that company's stock, causing the stock price to go up. This means that investors have an idea that the company has potential for growth. A low PE, on the other hand, might indicate that the current stock price is low relative to earnings. This might be due to increased earnings on the company side before stock value goes up, or if investor confidence goes down in that stock, causing a lower stock price because of less stocks being purchased. Since the ratio determines how much an investor would have to pay for each dollar in return, a stock with a lower PE ratio relative to companies in its industry costs less per share for the same level of financial performance than one with a higher PE ratio. Therefore, investors can use the PE ratio to help find undervalued stocks. You find the PE ratio by dividing price of the stock by the earnings per share, which I covered in my last slide. The final ratio we're going to be looking at today is net profit margin. To start off, profit margin is one of the commonly used profitability ratios to gauge the degree to which a company or a business activity makes money. There are different types of profit margins. Specifically, net profit margin is equal to how much net income or profit is generated as a percentage of revenue. It can be expressed by the equation net profit margin equals net income over revenue times 100% because it's expressed as a percentage. This margin is important because it helps investors assess if a company's management is generating enough profit from its sales, which is important for stockholders as profits are going to be distributed as dividends. Also, it shows whether operating costs and overhead costs are being contained well by the company. So net profit margin is one of the most important indicators of a company's financial health. Here's an example. There are two music stores, Music Store A and Music Store B. Music Store A has a revenue of $1 million, while Music Store B has a revenue account of $2 million. Even though from the looks of it, Music Store B has more revenue, which should mean that they should be generating more profit, Music Store A has a higher net profit margin of 6%, which means that the net profit of Music Store A will be $60,000 as compared to the $40,000 profit made by Music Store B because Music Store B has a lower percentage of 2%. We find the actual net profit by multiplying net profit margin percentage by revenue. Because profit is higher for A, we would want to invest in Music Store A instead of Music Store B. Once again, we've made it to the end of another video, so thank you so much for watching. I hope you found the content for fundamental analysis, both of the videos I made, really useful and helpful in the stock market. And as always, don't forget to like, share this video, subscribe to my channel Stocks Routines, and leave comments down below. I'd really appreciate to see some comments, either if it's questions relating to content that I cover or suggestions for future content. I'd love to hear your opinions and views. Anyway, thank you so much and see you next time.